All right, we have a lot to cover today. A lot came out from a news standpoint out of Washington. A lot came out. This has been a crazy busy week from a technical perspective on the markets in terms of bouncing up. So I'm going to break all that down. What's driving it now? What can we expect going forward, as always? Because that's the tone of this video, as always. Let's see what's happening. How does that impact our expectations? Because we always have to trade off of what we expect. So I'm going to help you build those expectations using the market forecast and other technical indicators. And then, as always, give you a way to trade something that was in the news today. So let's go ahead and get started. Today is Friday, February the 16th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching today. Welcome to those that are watching for the first time. I'm glad you found us. Keep watching every day. To make that easier for you, subscribe. Click that red subscribe button right down below the video. You can do that right now while you're watching. That will subscribe you to the channel so that you're always notified when these videos get posted. Also, hit the thumbs up icons right down below, right next to that subscribe button. That lets me know that you got something out of it today, and it also lets me know that you want us to keep doing it day after day. So it's a one-click way to give us feedback, the easiest way you can give us feedback. Scroll down further, comment on anything that stood out to you from this weekend's video. Just let me know what you learned, what stood out. In the video description, there's a link to join the daily email list. I send out an email every day. Me and Brandon both send out emails every day. Just one, from depending on who's doing the video. But we'll kind of give you a link to the video. We'll give you a summary of what's talked about, so you can kind of get an idea. Time-stamped segments, some with hyperlinks, so you can get straight to the segment maybe that you want to rewatch again for whatever reason. Follow me on Twitter for more content. In addition to these videos, you see my handle on the screen up there at DavidSettle42. Remember, also follow Brandon at Brandon Van Z, and also follow our Market Scholars account at Market_Scholars. You can see the account up there as well. And then finally, remember to like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. And then finally, join the Market Outlook community on Facebook. There's an address at the top of the screen. In the video description below, I've highlighted a link that will take you there where you can join. All right, well, let's take a look at the S&P 500 first then with the market forecast tool. And you see bullish posture, not quite above 50 yet. So that's when the clock starts. When that intermediate line crosses above 50, the 1 to 3 month clock starts. Now, granted, we are following market sentiment. We are relatively high. This would be, if we were to bottom out here, higher than even the last one. And this one, we talked about this in the last video. This one, the expectations were only maybe 1 to 2 months. And we talked about how, maybe that probably should have been the peak, but then the tax reform expectations pushed us up through. And you can see how we were starting to pull back here, and we never did. So you can see how the spike down in the momentum line, started the brief kind of volatility, and then we just never got that because the tax reform news started to come out and really affect things. So, so again, we're forming a high point of market sentiment that's even higher than that. So again, if we cross above 50, just because that lasted 5 months, which is way longer than even the best expectations, doesn't mean now that we change what we've seen in the past, right? This was, there was a reason for that, and we saw how it quickly unwound, how fast it unwound all the way back down to that level when market sentiment line pretty much crossed above 80. Because the market sentiment crosses above 80, the S&P doesn't go up very much typically. Usually it goes up to get there, and it doesn't go up past it. So if you're already close to there, then that's why 1 to 3, closer to 1 to 2 months is the expectations for the intermediate run, because there's not much room left to go. So that's kind of where we're at right now. Market intermediate lines at 48. It's close to crossing. You can see the near-term line's entrenched in that upper reversal zone. So the near-term line, and we've got 5 days up above 50. Probably going to get to that 7 days above 50, which, again, that's, it's like we didn't learn the lesson that if it goes up too much, it will typically go down a lot too, after that, if it goes up more than it should. And we talked about, we probably should be, peaking right about here, and then kind of with the resistance at that 2,700 and then coming down. But then we got that push, this late push with Valentine's Day, and then up through to yesterday even. closing above that high, that long upper shadow, and then now today, getting up to that 6-week moving average. You think this right here is probably a little too much of a push higher to be normal, right? So what just means that the near term pullback will probably be relatively large too. Again, now as we saw, that was a pretty darn good pullback, and yet that's the bounce. So just because we get big pullbacks that are bigger relative to these bounces doesn't mean that the world's going to end, right? The world didn't end here this first couple of weeks of February. So the world's not going to end if we get a deeper pullback. But don't be surprised if we don't pull all the way back down to 2650 because we went up so much. I mean, that's a lot of that. I would venture to guess that's a lot of fluff right here. And again, it's probably just because, it's an oversold technical correction that we push higher. The Russian news that came out in the afternoon, the Russian indictments from the special investigation produced a long upper shadow. Remember, long upper shadows are relatively bearish. Now, I'm not thinking that we're going to get a bearish trend because that's a strong support level now right there. But again, that might be the short-term peak because of that long upper shadow that brings us down to 2675 to 2650 before what would then be a higher low point. And then, a better spot for us to continue a new intermediate trend. So that's kind of what I'm watching for on the S&P 500. You notice just about all the indexes, as always, these correlations and that's something I tweeted out here, the correlations get closer to 100 when you can see that there's a correlation. See how the correlations spike up when we drop. They get really low when the market gets really high. There's what, 2000, September 2000. They get really low when the market gets really high because the market rotates. Different leadership rotates. People are looking to keep the market going. So they're looking, some things are overvalued, some things are relatively undervalued, and it rotates through to keep pushing up higher. But when everything falls hard, then everything falls, right? And then when everything bounces, when the market bounces, everything bounces. And that's why correlations get high, at relative low points on the market. Now, remember, the market didn't bottom until March of 2009, but that was kind of it was a divergent bottom, right? So you can see when we get spikes in correlations, that usually coincides with big drops and then big bounces. Now, you might get another lower low after that, but it won't be with the same strong correlations, and that will typically be a divergence form. So, look how fast we went, and that's kind of what we're seeing. The markets are all going to look very similar. The Dow Jones Industrial Average, you see the NASDAQ Composite here, which has an element of large cap tech as well as a bunch of small cap. This is the composite, not the QQQ, which is the NASDAQ 100, which is very large cap focus. This composite has a lot of small cap, and you see it looks very similar in the Russell 2000. Remember how the Russell 2000 had been a little different. Large caps and small caps have been behaving differently at sometimes. Looks almost exactly the same. Intermediate line crossing close to 50. Near-term line entrenched up there. So right now, everything's going to look very similar while these correlations are as high as they are. And then we'll find low points, and different things will take leadership, and different things will lag, and you'll see that rotation again. So we finished the week with a green arrow on the long-term chart, and we talked about now we get this. Now, as these lines start to close in on each other, that we'll get more arrows. Now, I still think, in fact, there's another tweet I put out there. This is this is purely coincidental, right? This is definitely not a cause and effect thing. But the year of the dog ends up being a pretty darn good year, a pretty good year of a return, the best year of returns from a Chinese calendar standpoint. And we had talked about from other technical reasons why 2018 should be a good year, but with higher volatility heading into the year. So we're gonna. I still think that we're 2673, so we're we're getting pretty decent returns now. But remember too, I've shown this before in previous. In fact, maybe I'll just kind of keep this line drawn here. All right, so this is the line that is a 23% return for 2018, roughly. And you can see it goes to. Try to get it to right there. So roughly about a 23% return. So I might have to move it maybe to 1 week over right there. So does that get us a yeah, there we go. So there's a 23% return to the end of the year. So you can see we are well above that pace. We dropped down below the pace, and now we're kind of right back at the pace. And again, I got that number from the average annual return for a month that starts the year with 5% higher. So January is a 5% gain or higher. The average return for those years has been 23% return, and just about every year has been positive. So, this is just average here, but there's your average. It doesn't have to do that, right? In fact, most likely won't finish the year with a 23% return because averages, it's like, the long-term market average is 8%. How many years actually finish with 8% return? When you do your financial plans and you put 8% or 10% as the long-term return that you're trying to plan for, remember that the market will probably never get that exact number. There'll be double-digit returns, there'll be losses, there'll be single-digit returns, but they'll probably hardly ever hit the actual average return. So when you're trying to go for a goal, like I'm trying to make 10% this year, just remember you want to make 10% over 10 years, which ends up being an average of all the ups and downs you get. So keep that in mind when you're trying to come up with averages. So we probably won't get that, but that's an average. So that kind of gives us a pace of what to follow. And so we can still trend higher. The mark here, let's go back to, just a little bit. There we go. We can probably still, well, in fact, did I already have one? There we go. So, there we go. So we can probably still trend. These lines will probably still go up to continue on that pace, but we'll have more. You can see that's where the 50-day moving average is. We're going to get more arrows. We're going to get more green and red arrows as we get to that point. You can see that. Like over here in 2013, we only got a couple arrows that whole year. That was a QE3 year. And then 2014, we had a good return. No QE. It ended right here. It was tapered and then ended right there. But as we were tapering and ending, we got a lot more arrows. And of course, in 2015, when we were done with QE3 altogether, we got a ton of arrows. And we were really flattening out and ended up with a really flat year that year in 2015. So that's kind of, this is probably what we're going to see. A lot of ups and downs as we trend higher. A little more volatility than what we were accustomed to in 2013. If we take a look at the 3 green arrow chart, you can see we crossed it back up above the moving average for the MACD. The stochastics already had. It's close to like the intermediate line on this market forecast, close to crossing above 50. There's still, the MACD is still well below zero. And remember, this is abnormal to get, to cross sharply above zero. We've seen in the past, and I'll remind you of this again, that I've shown you in this video. When we've been this low before, and we usually go right up through. Now, not always in the first go. You see that, how we go up and then back down. So it's not always on the first go here. But then we push our way up to a high MACD level on the positive side from top to bottom. Now, it doesn't always work that way coming down from these highs. We typically grind. So that's very abnormal for that kind of situation. You notice we kind of had it there at the end of 2015 heading into the new year. But not abnormal for it to go the other way. So that's kind of what we're expecting, but it might not be on this first run. In fact, I don't think we will. I think we'll hit this and come back down into this area. Maybe retest down to 2,600. It would be a deeper pullback, but get a higher low point on the MACD, and then make our way up towards the gain. Follow that trend line there on the red line. So that's what the 3 green arrow chart's looking like. The intraday charts we're finally starting to get a slowdown on the range. We're just over 3 points, which is still relatively high, but below the average now. Just over a 3-point range today. Higher high, higher low, getting up to last week's high point. And you can see from a 4-week range, we're up in the upper half of the range. The average range was right about this 270, 272, right in this area, 271-ish. 270. So we got above that. We got above that high. So now we're kind of in the upper half, just a little bit in the upper half. We'll see, again, if we pull back down below 270, again, look for this a higher low point to develop, and you've got your Fibonacci lines of where you can watch for it to develop. It'll be, if this ends up being a peak, down into this area right here. I mean, there's going to be some obvious support in this area, 264 to 267 from a 50 to 38% Fibonacci level. Maybe a little bit lower if it kind of follows through, but considering that this high is a little bit higher than that, don't be surprised if this low is a little higher than this one. So it's not going to be a picture perfect, as rarely it ever is, a picture perfect inverse head and shoulders pattern. You can see volume really dropping off after a huge amount of volume the week before. If you take a look again at the 1 week, just about average, 160 million, but the range only 3.05 points. Just for some perspective on last week's volume was the highest we had got right there since that October 2014 for a negative, for a down day. Of course, August 15, that was a positive day of volume. Positive week of volume. So volume really tapering back down. That was a big spike in volume. You see on a volatility rate, when you put it in perspective, 160 million still, that's high, but it's not abnormal. It's not like huge. It's not, you can see 3-point range is actually below. So, when we pull back here, we're not going to get moves like these big, 10-point ranges again. It's gonna be more in the 3 to 4-point range, more than likely, enough to continue to bring this down a little bit. If that's the case, great. If it's not the case, if we're getting 5, 6, 7-point drops again, which is not expected, but if we did get that, then that's not going to be a good thing, right? Then we could push back down, probably further. But if we stay in the 3 to 4-point range, which is what I do expect, then look for a higher low, and then the intermediate trend to continue. From a volatility standpoint, you can see, we are bouncing up, just like we had talked about, getting that low, bouncing up, probably going to bounce to this 22.5, maybe 25 range, and then roll back over again is what we're looking for. That's on an absolute basis. You can see on a relative basis that we're still in that bearish sweet spot, right? We're still, for volatility, that bearish sweet spot of 1, right around that 1 area, similar to the 85% on the bullish sweet spot. So we're not quite back getting into that neutral to bullish range yet, which the neutral range is the 90 to 95%, and then getting below 90%. Now you're back. You can see that's when you're really bullish on the markets from a volatility standpoint. All right, now let's transition into what's driving the price action today. And there's a lot of news from an economic standpoint. Of course, the news in the afternoon had to do with the investigation that brought some prices down. But from the beginning of the day, housing had a really good, strong number, the second best numbers had of this recovery. Now, keep in mind, mortgage rates are rising pretty darn rapidly. So that's going to eventually have a negative impact. And I know, speaking purely anecdotally, like, in the situation I'm in right now with with hardly any equity in my home, and my home's got a pretty decent value now, and as it's growing, and I'm paying next to nothing in interest with the interest rate I have, it's kind of hard for us to make that decision to sell our home, to buy an expensive piece of property to build a new home at a higher interest rate, a much higher interest rate than what we're paying, and so that's the decision, that's most likely not just impacting us and that's purely anecdotal, but those higher mortgage rates are going to eventually start impacting the real estate market. Of course, a good job market will just overcome that. It doesn't matter, as long as there's job motility and wages are rising, that's going to overcome higher housing costs. So that's going to, and of course, same thing with me, but that's going to impact a lot of other people. So that if the employment market stays strong and wage growth stays strong, doesn't matter. If it stays level or maybe even starts to come down a little bit, then inflation keeps rising, then that's going to really matter to the housing market. Now, how residential real estate investment is a kind of a leading. That's a leading part of the economy that we'll definitely keep an eye on. Remember, that's what burst first before the last recession hit. Of course, big bubble there, but that's what turned over first before the last recession. You can see economic surprise index pulling back, but still, 35 still high, relatively high levels, because that wasn't the only. We had consumer sentiment with its second strongest number that we've had here since this recovery. You can see import and export prices both rising really strong on a year-over-year figure. That's what this chart shows, year-over-year growth, as they're rising at high levels. So that's impacting interest rate hike expectations. So this is for June. We're already, we're at like 83% odds for a rate hike in March. So we're pretty much going to get that one there now that we're past the January meeting. So we're probably going to get a rate hike at the next meeting. And the odds of a second one by June are up to now 60%. So you can see how we were kind of pulling back, but we really took off. And, it's at its highest level ever. That particular futures contract. These are all futures contracts. That futures contract has highest level ever, or at least highest expectations, highest rate odds ever. And you can see if we go out to September now, looking for that third rate hike. So that would be now down to about 200, 225. Not so strong. So it bounced back up lately, pulled back a little bit at the end of the week, but still higher than just having the 1 for the year. You can see there's 2, so still pretty decent odds for 2 by September. At least 2. Here you have to add these two together to get at least 2 by September. So that's over 80%. So pretty decent odds. And then of course December, looking for the 3 rate hike. So that would be this dark blue line right there, 225 to 250, or 4 for December. The odds of having 3 are pretty darn good too. You have to add these two together. So there's 3 and then there's 2. So, we got pretty good odds of the base minimum of 2 hikes by September, 3 by December, depending on whether it's June, September, December, whatever. But that's kind of what we're in March. March already being the 1. Then with the others, who knows? But the odds of getting that 4th one, so March, June, September, and December, are rising because of how strong the data is. And you can see we've pulled back on estimates as we typically do, but we're pulling back from higher levels than we've seen before. Usually we kind of start off at 4. that peak right there usually is around 4%, and then we pull back down. This got to the 5.5 almost, and we're pulling way down to 3% instead of way down to 1% or 2% like we had been seeing. So we're continuing to see consistent, strong economic growth, and that's gonna kind of give a lift to the markets. Doesn't necessarily mean that we'll go up every single day like last year. And that last year was such an anomaly, and we've seen that there probably has been a little bit of malfeasance with the VIX pricing. They keep volatility as low as it was for so long, but there's still, we're not going to get that same kind of everyday up and an up day and no 3% pullbacks at all. We're going to get pullbacks during this year. It's going to be more normalized, and then last year just wasn't normal. But that doesn't mean that we still can't finish the year positive and on a strong trend because of the great fundamentals that the economy continues to still show. We look at the how things finished the week, and you see the dollar finished the week with good gains this week. That pushed down emerging markets, that pushed down gold. And that was just today. We can see for the bounce, there's the from Friday. Well, no, that wasn't from Friday. We need to go one more right there. So from Friday's close on, stocks did really well. Emerging markets pulling back. Friday, just some of its gains. It had a really good week. Everything kind of flat, so you had to put that scale in perspective. And long-term bonds rallied, so yields down just a smidgen, but bonds lagged behind stocks, but they rallied, and the dollar was down, continuing its bearish trend. And we talked about that. If dollar continues that bearish trend, here's a pretty good outline of what to expect. Now, you can see gold pacing. It actually was outperforming crude oil for the longest time before this kind of late rally that pushed crude oil up. So that's more of this risk on. So the market's kind of in risk on mode. There's going to be bouts of risk off. There's going to be bouts of pullbacks, and we're going to. 7% gain in a week is a pretty darn good, and that's pretty darn good for a few months, if not a year. So we're going to get pullbacks, and you can see, when you have these strong runs like this. This is this is a 2-week chart. What went down the most has bounced up the most, and that's going to be the case Two, what's going to go up the most is going to pull back down the most when we have our pullbacks, because that was the case here. They went up the most, they pulled back down the most, and now they pull back down the most, they're going to bounce the most, and we're going to have that kind of seesaw where we diverge and converge and diverge and converge from an asset class standpoint. Whereas from a sector rotation standpoint, like I said, when everything bounces, this is from the low on Friday, typically everything bounces. Now some things will start to lag, and there's your safe haven assets, but even they have been up for the week 5%. Now, not for the week, from the low on Friday. From the low on Friday, the S&P is up over 8%, but you notice there's only two sectors that outperformed the broad market during that time, and one of them was technology, and we focus a lot of our trade ideas lately in that technology sector, looking very strong, whereas your laggards continue to be real estate and utilities. Even though bonds pull back a little bit, that at least allowed them, remember they've been like negative while everything's been rallying, so at least that allowed them to have some positive returns. And staples, you can see crude oil, energy stocks lagging behind. They were a big bouncer. In fact, you can see materials and energy had a underperforming week, a positive week. I mean, you can't complain with 6 and 7% returns, but the broad market got 8%. So everything's in perspective, and technology up over double-digit returns off of that low point. So interesting to see that those two areas lagging a little bit when the dollar was down for this week. You wouldn't expect that. As the dollar continues to trend lower, expect energy and materials to push their way back higher and to be leading areas again. Of course, the other big news story that came out was the tariffs that were announced in the steel and the metals industry. And you can see, here's a stock I'm going to look at here, X, or U.S. Steel. But you can see the whole industry, the metals and mining industry, really taking off with decent volume today. In this case, 3 green arrows, and U.S. Steel breaking out. There's other stocks that are doing really good too, like Nucor, but not quite breaking out above those old highs. U.S. Steel has, in fact, if you go to the longer term chart, you can see, it did break out above 40 once before, came right back down 3 weeks later, dropped all the way back down almost 30, and 4 weeks later it did get down to 30. So it didn't quite take that go around. Will it take this go around? If I were to go even further, a little bit of a higher low point, inverse head and shoulders, potential to go up to 60 here. Are we going to get to 60 in a month or two? Who knows? So and it's got if you look at the technical indicators, the intermediate line's crossing up above. It's crossing above an upper Bollinger Band, even though that Bollinger Band's already pretty darn wide, relatively speaking. It's compared to like how wide it got here. Of course, it got really wide here on a big drop on earnings. But is all that in the past now, and now this tariff's going to help us push up higher back to its previous glory years. That's obviously from a technical standpoint. There's a lot of positives here, a lot of breakout positives. Usually when you get a breakout, you get a return move, maybe a pullback down to 40 all the way, maybe just 41, 42 before we continue higher. So one thing we can do here is we can say, okay, let's do a long vertical. So we're not going to necessarily buy the stock because it's you typically don't want to chase. This is a big move higher. Ideally, let it pull back to 40. If it holds that support and bounces, good buying opportunity there. And then you got that target to 60. But in this particular case, if we were to say, okay, what if I were to sell, go out here and sell, at the 30 delta, go out to April. It's a little bit further away than normal, but I wanted to avoid these weekly, so we'll go out to April here. And March is too soon. So we'll go out to April, and we'll go out to that 30. Let's see. Let me make sure I got the right one. There we go. Yeah, we'll go out to that 30 delta, low 30 deltas. Give us a pretty good move for it to go to. So in this case, it would be 50. But instead of just going to 50 and say 48, which would be kind of that normal $2 range. Instead, what I'm going to do is I'm going to sell 2 of those. I'm going to sell 2 50s. In this case, I'm going to get about 325, 335 in that range. So now I'm going to pick the one to buy that won't cost as much as 335. And so that's why I've selected this 46, because at 320, that's actually a little bit less than 2 combined short strike prices. Now remember, when I sell a short strike price, I want it to stay below 50. Right, so if I want it to go up, it's okay if it goes up. Remember, even if it pulls back a little bit, I'm okay with that. As long as it stays below 50, I keep that 335. But now I'm buying at 320, so if it goes up, I make money from that one. Right, so it can go up to 50. If it goes up to 50, then I get the $4 from this one. And I get to keep the 335 from the 250s. If it closes right at 50, those two on April expiration, those two expire worthless. I get my $4. I get the 335. I get $4 in there. But remember, it's costing me 320. And so I'm getting about 80 cents from that one plus the 335. So that's my maximum gain if we get to 50. So now you can say, okay, well once I get above 50, I start losing some of that gain. So again, the 334, I guess it's 334, plus the 80 cents up to 50, and now it goes up above that, right? So I keep getting more as we go up to $5. I get $5 minus 320. So that's what the Analyze tab looks like this, right? So 50 is my maximum gain. You can see about 420 some odd dollars there. It's the combined credits of the $50 strike plus the return I get from the long call. But you notice here that if it goes down from here, I still get $22. The credit I get from getting the trade, because again, 2 strikes, I get my credits. I might, this 46 could go worthless. A 320 can go completely worthless that I paid for the long call. But because I made more from selling the 250s, it can go all the way to 0 for all I care. I'll still make $22 no matter how far down it goes. So I've taken away a loss to the downside. So if we end up chasing it and it pulls way back for whatever reason, okay, fine. But if it keeps going up, and this range here is 1 standard deviation between now and April, now you notice that's where my break even is. So it can go all the way up into this area, and I'm going to make something with the potential, and you can see my buying power effect. If I were to confirm and send, you can see on this particular paper trade account, I'll need about $600 in buying power to be able to make this trade. Now, everybody's account might be a little different depending upon where you're at, but that's, I need to do that again. I lost it. So we'll do 250s and then buy the 46, and then we'll analyze that. All right, so so that's how much cash I get, and I got the potential for making 400 if it goes anywhere in here. You notice I'm making this range here between 48-ish and 52.5-ish. I make $200. Again, out of the 600 that buying power that I'll have to use for this particular example account. So that kind of gives you an idea of my potential return. And then again, if it goes down, I still get something. I'm not getting any loss to the downside, minus commissions, of course. And then if it goes way up to the upside, that's where my break-even is going to be. So I got to watch if it were to break out above 50 and keep going up to 60 and 55 and above. Then we can say, okay, how much loss am I willing to take? Because now, yes, my long call is making money by every point it goes up above 50, I lose. I'm adding intrinsic value up to that point. So and once I get past that break even, the 422, plus the 50, then I start losing money. So that's where we have to say, okay, I'm willing to go up to whatever point that I'm willing to lose. That would be my trade risk for every contract. And then my portfolio risk is how much I'm willing to lose total on the trade. So that could be 1% of my account, whatever. I take that number, divide by what I'm willing to lose here, which would be my stop order for one spread, and then that tells me how many spreads I can do. So a way to do some position sizing. So you want to have some kind of target up here to the top side where you're like, if this goes up to that level, then I want to get out. And you can see, that's. You can't, if I zoom in, you'll lose, but that's, about $50 right there. And you can see these old highs in 2011 is about, $57, $58. And we've got $4 of potential reward. So if you're going for a $4, 1-to-1, because this is a pretty decent odds of success, then, 1-to-1 reward to risk ratio, then you're looking at, about 58, 59, somewhere up in that area, a little under 60, that you're like, okay, cut my losses and I'll take that will be a 1-to-1 reward to risk ratio. You might go a couple bucks to try to keep it a 2-to-1, so you'll be looking at 56 to 57, in that spot where you say, you know what, no, I'll take it. I'll take my losses at that point. Because if it goes up to 60 or 70, now you can see that it just keeps going down and down, right? There's no flat line anywhere. There's no maximum loss to the upside because you got that one uncovered short call that's naked that's got unlimited risk. So that wraps up quite a busy day from a news perspective, as well as quite a crazy week from a technical perspective. A big V bounce here. Remember how high the volatility was? And volatility is high. You get big moves up and down. And now we've had our up move. Don't be surprised if we get a little bit of a breather. And again, the more abnormal the conditions are, as we saw heading into the end of last year, the beginning of this year, the more abnormal the moves are. And it's regular breathing, right? Inhaling and exhaling, and the more regular it is, great. The more abnormal it is, you take the bigger inhales, longer and bigger inhales, you're going to eventually exhale. And the more you hold it, the more you inhale, it's not going to. So we're kind of getting that right now too on a short-term perspective. We've had a good bounce this week. Was it too much? That we'll get, don't be surprised if next week we get a little bit of a pullback, maybe not all the way down to those lows from a couple weeks ago, but still, a deeper pullback that might bring out the, bear trap, blah, blah. No, it's not a bear trap. We just went up a lot this week. We're going to pull back down most likely next week on a short-term basis, but then that could provide us a nice bounce. Again, of course, we could just keep going up every day because the market can be crazy, but if we get a pullback down the Fibonacci retracement levels, get a higher low point, then we're back on that regular inhale, exhale mode again. As always, thanks for watching. I appreciate everybody watching. I appreciate the likes, the comments, the shares. I really appreciate all the engagement that we get with these videos, both here on YouTube down below as well as on Twitter. Again, follow me on Twitter if you're not already. Even if you're not a Twitter person, if you want content like this and you want me to keep sharing with you in bite-sized form, follow me on Twitter. That's great for you. You don't have to tweet anything. Just follow and lurk and watch. Take advantage. And then, of course, join the community. There's a lot of people else out there that are watching these videos just like you. So join our community on Facebook. The link's down in the description below. Have a great weekend, everybody. Great President's Day holiday. Won't be back on Monday. Tuesday, Brandon will be back with his video, so stay tuned for that. We'll see you then.